Hi, my name is Hannah Holmes, and I'm on the Startup Week Student Executive Committee. I'm going to say a few words to introduce our next speaker, Eric Franchi. So Eric graduated from Penn State with a degree in marketing and is a founder and investor in the digital advertising and marketing industry. As a founder and operator, Eric was a co-founder at Undertone, where he helped the company grow from its bootstrapped beginnings to a leader in creative advertising technology. In 2015, Undertone was acquired for $180 million. And now Eric serves as general partner at AperiamVentures, a specialist venture capital firm focused on advertising and marketing technology. The title of Eric's talk is Demystifying Venture Capital. So please help me welcome Eric Franchi.
Thank you. So formal. How's everybody doing today? Good. Just getting started. Demystifying Venture. So I didn't pick the title. Matt picked the title, but I think it's a good one because venture is a space that it's in the news all the time. Like companies are raising money, venture funds are getting really large, but it's like not well understood unless you're on the inside. And if you're looking to get into startups, if you're looking to get into venture, if you're looking to get a better understanding of this stuff, I think it's a category that's like worth having a bit of an overview on. I guess maybe just to get a view for the room. Show of hands, who is interested in getting into startups for their career? Whether it's starting one or building one. Okay, half the room. Who's interested in getting into venture for their career? Okay, who's interested in actually doing both? Got it, okay, that's the right answer. So I was actually having coffee this morning with Jason and Matt, who I'm going to be doing the panel with later on, and like we all resoundingly agreed that you are a better VC if you have startup experience, because there's only so much you can like sort of understand and do via spreadsheets and all of that stuff. You need to sort of like do the work. That's a different topic. So we'll get started. I don't have a ton of slides, and hopefully we can keep this super conversational and fun. And my goal for today, for all of you, and it sounds like everybody in the room is interested in startups or interested in venture or interested in the whole ecosystem, is to basically break this down and help you understand and come away with basically the one law that rules everything when it comes to venture capital. Venture capital is like somewhat of a complex space to be successful in. But it's actually very simple in terms of how success is generated. So if I've done my job today, you're going to come away with basically understanding like the one law that rules everything when it comes to VC. It'll make you a better founder, make you a better VC, or have a better startup career. So it'll be pretty simple. I'll walk through venture as an asset class to help you sort of get a better understanding of venture, full stop. We'll walk through like how venture capital works. So if you're ever going to be pitching a venture capitalist or like sort of wanting to understand a firm, we'll do that and just kind of sort of walk through some examples of how this stuff all works in the real world. And again, we'll keep it pretty high level and have plenty of time for Q&A at the end. So venture. Venture is a subset of private equity. If you think about just like the investment world, you can break it down very simply into two categories. There's publicly traded stuff. I'm talking about stocks, right? So like the stock market. And then there's private. Private equity is everything that's not public. Private equity as a class tends to focus on the later stage. So companies that are large, that are ready to go public or are public and they get taken private, like that's classical private equity. Venture capital is the early stage stuff. Venture capitalists invest in startups. Those startups can be everything from, a person and a PowerPoint, like my friend over here, just getting started, or companies with revenue, traction, and are looking to get to the next level. Venture is actually a niche industry. So venture last year was like 200 billion or so in terms of the total amount invested in startups in the U.S. And as a percentage of GDP, that's really tiny, right? If US GDP is 25 trillion, venture is 200 billion, that's like less than 1% of GDP. But venture drives so much of GDP, which I think is a very important thing to think about. So like, some stats, and all this stuff is sort of like extremely available. on the internet, but like 11% of private sector jobs ultimately are from venture-backed companies. 21% of revenues equivalent to GDP come from venture-backed companies. I think the big thing is the biggest companies in the world and the biggest companies in the US, and I'll name three, Apple, Google, and Microsoft, they have two things in common. Number one, these companies are now worth $1 trillion. Maybe three things in common. Number two, we all interact with them every day, right? The phone's in our pocket. We look at Google for everything, and Microsoft tends to focus on the enterprise. And then number three, at one point, these were all companies that got their start with venture capital investment. So that's the whole goal behind venture capital, is to find the next Google and find the next Microsoft, to ultimately help build those companies up and create a lot of value along the way, right? So niche industry, relatively small in terms of the asset class, relatively small in terms of the players around it. There's only a few thousand venture capital firms in the US at a particular scale, but outsized influence, right? The 200 billion that drives the 25 trillion. How venture works, it's pretty simple. And there's basically a few constituents that you need to think about when it comes to venture. The first are who invests in venture. These are known as limited partners or LPs. We'll use acronyms. LPs in venture funds are not individuals. So unless you're like a high net worth individual, you have a family office, you're not investing in venture capital. LPs in venture capital are university endowments. So Penn State, we actually met with them this morning. They have a big endowment fund that has a significant amount of their capital that invests in venture. Pension funds that need to have some view and to be able to deliver sort of like market-beating returns to pay on their obligations to all of the workers. They're an investor in venture capital. Family offices, corporates, so on and so forth, right? So it's an asset class that isn't necessarily available to most people. And frankly, that's a good thing, because venture capital is risk assets. We'll talk about this a little bit later on, but ultimately, there's the opportunity to drive like significantly high returns, but also a lot of venture-funded companies, they end up failing, right? And that's just the practical matter, right? So LPs are the investor class for venture capital. GPs is the other like acronym you need to understand and be aware of. GPs are people like me. We run venture capital funds. So in the whole flow of things, GPs, we will raise funds from LPs. We will pull that capital into a fund and then invest it in startups. Fund strategies, fund models are very different, but ultimately funds will invest in a number of startups per fund, anywhere from 10, 40, up to 100, depending on strategy. We can get into how that stuff all works later on. Those funds are invested over the course of a handful of years, typically 3 to 4 years, and they're kept alive for 10 years. And this is a very important point. Startups take a really, really long time, if they're successful, to become successful. And I feel like this is something that's not very well understood. And partly, I think the industry and the media is to blame, because there's all these like highlights of like startups emerging out of nowhere and getting 100 million users and IPOing, so on and so forth. The reality is the best companies take a decade or more to become the best companies. So, you'll raise a fund from endowments, institutions, high net worths. You'll invest that fund over the course of 3 or 4 years. You will then manage that fund for 10 years. Everybody following it? Good, okay. If you've done a good job and you've invested in companies that exit, and by exit, I mean they go public, or there's an acquisition by a larger company for a greater multiple than what you invested at, you've done your job. You've created profits within that fund. Those profits are then split between the LPs, the original investors, and the GPs, those who do all of the work. LPs are limited to money, GPs do all the work. That split is 80-20. So LPs will get 80% of the profits. GPs, the fund managers, get 20% of the profits. When you start to multiply this across some of the best investments, how large they end up becoming, how large funds end up becoming, becomes an asset class that becomes pretty attractive from an investment perspective. That's why endowments, pensions, so on and so forth, invest in venture. The best venture funds beat the stock market over the course of a long time, sometimes by upwards of 10, 15 points. So it's very, very significant. And the other thing is, this isn't just about money. There's a reason why folks like me get into venture. It's to make an impact. And then also the LP base is typically institutions and companies and organizations that you want to see do well. So there's like real alignment of incentives if you do this right. Like you're finding great startups, you're investing in great startups, you're helping those startups, but ultimately you look to do some good in the world by creating all of the profits as a result. So that's how the whole thing works. Very simple. GPs fund LPs. LPs fund GPs. GPs deploy against startups. Profits are created. Most of those profits go back to the institutions. And the GPs keep, some of the profits for doing the work. Pretty simple stuff. So this is what nobody understands about venture. And frankly, in my conversations, most venture capitalists don't even understand this stuff. So most startups fail. This is a pretty well-known thing. Like there's actually like stats by the government that say like 85% or so of small businesses fail after 1 year, 90% after 5 years, so on and so forth. With startups, because of the nature of it, technology companies are typically like high-risk entities, the vast majority fail. You go into this game, you go into venture, you go into startups, quite frankly, realizing this. It's never anybody's fault. It's typically just like ideas, timing, market, so on and so forth. Most startups fail. So as a venture capitalist, the odds of you succeeding and delivering those profits back to the LPs who are looking to do so much good in the world and pay people for all of their time at companies, it's stacked against you from the start. So you need to invest in and find the absolute best companies. And that's how venture capital works. Like we take pitches all the time. Oftentimes, we'll look at, depending on the fund, your strategy, how big you are, 10, 20, 50 companies a month, and invest in only a few. There's a reason for this. It's called the power law. Have I ever heard of the power law? Okay, so the power law is pretty simple. It's sort of a more extreme version of the Pareto principle. What is the Pareto principle? Okay, so it's called the 80-20 rule. It was named by an Italian scientist, I think back in the 17 or 1800s. His name was Wilfred Pareto. He noticed that 20% of, I think, the bean plants in his garden produced 80% of the beans. And then all of a sudden, he started going outside and realizing that there's this rule that applies to everything. So like 20% of the work in a given company, 20% of the individuals tend to drive 80% of the outcomes. There's this concept called the Pareto principle. It's the 80-20. With venture capital, it's even more extreme. So in a typical venture capital fund, you might invest in 10, 20, 40 more companies. The best company will return as much or more capital than all of the companies combined. That's the power law, which is absolutely crazy because you're there just making decisions all day long, knowing full well most of them are going to be wrong, and you need to find, back, and support the absolute best. So that's the whole thing about venture that very few understand, which is the power law drives everything. That then also informs your investment decisions. You need to make investments as a venture capitalist. And again, if you're looking to start a startup, pitch a startup, this is important stuff to understand because you need to help people understand why your business might be one of those. You need to invest in companies that have an absolute chance of returning your fund. If you raise a $100 million fund, you need to write checks that you think can drive 20, 50, 100x returns to have a chance of being that one that returns the fund. This then probably explains why it's really hard to work with venture capitalists. Like, we're not a great bunch of people to ultimately work with because we say no all the time. It's just the nature of the job, right? Every company that we invest in, if we understand this principle, if we believe this principle is data backed, that the best companies will be the absolute outliers, the absolute returns, we need to find companies we think could be ultimately world-changing, world-beating. So most of the companies that we might look at in terms of our fund and any venture capitalist you talk to, they're going to say no because they need to have deep belief that this can be a fund maker, a fund returner, right? So you have to believe that the best companies will drive most of the returns. You have to invest in every single company with the belief that they could be one of those companies that drive all the returns, and basically nothing else matters because your goal is to build a fund that's profitable, and you need to have actions that drive towards that. This is also why not every company should be even a venture-backed company. I think the majority of companies that start could be like wonderful, profitable, great businesses to own, great businesses to work at. They just might not be the next Uber, the next Airbnb, the next Microsoft. And that's totally okay. Venture is for a very specific subset of companies that have a chance to basically dominate or create a new market. And the other thing that's really weird about this stuff and really hard about this stuff is those companies inherently, they kind of look really weird when they start. The canonical examples are Airbnb and Uber. When they were first pitching, and there's like, emails that are out there on the web, you should read this. When the founders of Airbnb were first pitching this concept, it was basically like, hey, yes, we're gonna start this business and we're gonna let people rent out their couches to complete strangers and make some money and build a marketplace around it. So it was literally air bed and breakfast. And people thought this was crazy. They're like, you're gonna like introduce all sorts of risks of axe murderers and everything like that. Nobody really, except for a few, realized like, hey, if this thing could work, this could change travel. This could upend the hotel industry. This could create an entirely new revenue stream and an asset class of real estate, right? So the best venture capitalists, they might look at things that others think are really weird. They might look at things that others have all passed on and ultimately invest in those because they think, wow, if this works, this could be a world-changing company. And there's the same story that can be said for Uber and Apple and all of these companies that we use and we interact with every day. So this concept of the power law is super, super important if you're gonna work at startups, if you're gonna start a startup, if you intend to get into venture in any way. Make sense? Cool, great. So ultimately, as a VC, you need to do everything that you can to tilt the odds in your favor of ultimately investing in those startups, right? And this is where I think, a lot of experience working at startups can be helpful to you. Because if you work at startups, if you've seen what great looks like, if you've been on a rocket ship or two, you sort of get a view for how a great startup might look like in the early stage. And there's thousands of venture capital funds. There's ultimately thousands of venture capitalists. We're all doing the same thing. We're all approaching it from a different perspective because there's no rule, there's no playbook for this. So I'll give you an example. So my fund, we invest in one sector and one sector only. It's technology companies that are looking to transform marketing and advertising. Giant space, advertising in globally is $1 trillion market. Digital advertising, $700 billion market. It's constantly changing, it's constantly evolving. There's the opportunity to build billion-dollar companies all the time. And this is a space that we know quite well because myself and my team members, we've built companies in this space before. So we try to tilt the odds in our favor through number one, only investing in what we know. So prop tech, climate tech, autos, all of that stuff. I mean, these things are awesome and I think they're incredible investment opportunities. I just don't know anything about them, right? So it'd be very difficult to sort of have the learning curve of getting to understand those industries versus an industry that I personally know really, really well, right? So for us, we stay focused on what we know. We'll have a thesis around where that space is going. And again, this applies to every VC. And we'll invest in a number of companies that align with that thesis. So we might have a thesis around AI. We might have a thesis around how linear television is going away because you all don't watch TV at all, right? You watch videos on your phone, you watch videos on streaming devices. We'll invest in multiple companies in those sectors that we think are gonna be the next sort of billion-dollar markets, stay close, and then ultimately end up double or tripling down in our winners. And we've been at this now for 5 years. I graduated in '98, sort of found my way in the world, for a couple of years, and ultimately I've had 2 jobs. I ran a company for 15 years called Undertone. It was an advertising technology company. And 5 years I've been a venture capitalist. So we're still really new to this, right? If you go back and sort of like think about what we said before, the best companies take 10 years to ultimately build and pick up steam and accrue those compounding gains. So we're still super early at this, but we're starting to get, I think some of the indication that what we're doing is on the right track. So we've had our first big exit out of the portfolio early this year. It returned 13x of our initial capital. So still not a fund maker, but on the right track. But this is a long-term game. So there's these two concepts, right? It's like finding, identifying, investing in the best companies and working with them for the long term to ultimately be able to have a shot at one of those companies that ends up being one of those 10-year winners. So this, I think, is like, so number one, hopefully this now makes sense in terms of this idea of a power law, how that's the most important thing to understand in venture, and this idea of sort of like working at it a long time. And if you understand that, you understand venture, you understand startups. All the work that gets done along the way is obvious. But I think the other side of this is super interesting in that, somewhat like that Pareto guy, if you start to see the power law, if you start to see this idea of, sort of like compounding over time, you see it everywhere. So now that I've been, part of this whole industry and ecosystem for some time, power laws exist everywhere, right? Think about athletes. The best athletes are so far and away better than their team, right? Maybe LeBron James is the example. His stats are so much higher than everybody else. His take home in terms of his compensation from contracts and endorsements are so much higher than anybody else, probably his entire team put together. The best cities, right? New York City has such a concentration of people because it's one of the best places to live in the world. There's more people that live in New York City than all of the boroughs and all of the towns around it. The largest earthquakes are larger than all the others put together on an annual basis, right? So there's a lot of power law. Once you see it, you start to like see it everywhere. And I think it's like, it's important to think about, regardless of if you're gonna build a startup, join venture, or just like have a career, keep in mind that the best companies end up being so much more successful than all of the other companies. Apple, Google, Microsoft, they're trillion-dollar companies. The rest of them don't even come close, right? So if you have the opportunity, if you have the choice to ultimately join a company that you think is gonna be like one of those world beaters, one of those, sort of like quasi-monopolies, you'll have an opportunity to, I think, have far more impact. You'll probably, with stock options, make a lot more than with any other decision you might make, right? So looking for those companies that might be the absolute beaters in terms of what you're gonna start or what you're gonna join is super important. And the other thing, this idea of companies taking up to 10 years or more to ultimately become really successful and distance themselves in the pack. Like, I've been sort of working for as long as everybody here has been alive. From my observation, there's a parallel here to careers, where oftentimes, like, careers, they take a long time. You could be working 5-7 years, not think that you're starting to like build up some of that compound interest, some of those compound gains, and ultimately be in a position to make your own choices of what you want to do with your career, whether that's going to a new company, starting a company because you've built up like an incredible network, an incredible skill set, or have any choice that you want, right? So these ideas of power laws and compounding, they apply to startups, they apply to venture, but frankly, they apply to you all as well. And hopefully these are things you can just, sort of like think about, take with you and move forward with, and, sort of like use them in consideration for your careers. Just a couple of examples and takeaways for folks. So when I said before that the best companies end up being the best companies, these are some examples of some of the best venture investments of all time. The other thing to note is you all know these companies. You all interact with these companies every day, right? WhatsApp, Meta, own Instagram and Messenger and so on and so forth. I know nobody uses Facebook, Google. Like, these are companies that are ingrained in our lives. And the returns from the initial venture investments in those companies are absolutely transformative, and they're some of the best investments of all time, right? So when you get this right, you not only find and fund companies that have an impact on the world, impact on everybody's day-to-day life, make them better, but ultimately they're transformative from an investment perspective. And again, we do this partly because it's an awesome job, an awesome game, but partly because the profits, 80% of them, go typically to really good organizations, endowments, pension funds, so on and so forth. So this is all about ultimately the impact you can make. Two, if folks are interested in starting startups or getting into ventures, two suggestions from a reading perspective. The first is a book called 0 to 1. I read this when I was first considering the move from running startups to becoming a venture capitalist. It was written by a person who also ran startups and became a venture capitalist named Peter Thiel. He's extremely controversial. I don't endorse his like political views, but it's a series of essays that are like really, really interesting and different about startups from a person that, you know, has sort of studied it from the beginnings. And he's the one that actually introduced me to this concept of the power law. And again, once you see it, you can't unsee it. So again, 0 to 1, incredible book. It's a series of essays based on a class he used to teach at Stanford. The other book, and this is also from a founder turned VC, is The Hard Thing About Hard Things. It's the best title ever. It's another series of essays about basically everything to do with startups that they don't teach you in school, and they don't even teach you when you get jobs. So two great books that if you're looking to embark on a startup career, if you're interested in venture, frankly, if you're open to these types of topics, I would recommend you read. They were very influential on me, and I feel like they've had an impact on the work that I've done. I think that's it. So again, power laws, compounding. Think about it, keep it in mind. If you're going to build a startup, power laws rule everything. If you're going to pitch venture capitalists, help them understand why your company could help return their fund. And if not, maybe you need to think bigger. Maybe you need to think about a bigger market. And ultimately realize that this is a 10-year game. If you're going to start startups, if you're going to work at startups, this isn't necessarily about like killing it for a year and a half and selling to Meta like Instagram did. There's only one Instagram, but there's lots of companies that 5, 7, 10 years later, they became incredibly successful. That's what I got. Thank you. We got plenty of time for Q&A, so just shout it out. Please. Okay, please. Mm-hmm. Yeah. 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 That's a great question. What was your name? Kyle. Thank you, Kyle. So Kyle's question, and see, Matt, I'm doing what I'm supposed to be doing. I have to repeat questions for the folks that are dialed in. Is the pace of consumer adoption changing how we might invest? And the answer is absolutely yes. It's made venture both harder, but it's also made it bigger in terms of the opportunity set, right? So the last great platform shift was a shift from all manner of computing to mobile. Mobile started as this like, kind of cool concept of, oh, wow, you can walk around with a phone in your pocket, to ultimately the iPhone changed everything. And now there's as many smartphones as there are people on Earth. That then accelerated the change of everything. That led to the birth of social networking, that accelerated how people interacted with video, like it created like incredible amounts of data. And all of that stuff, because these are devices that are on us all the time, it just created a ton of chaos and a ton of change, and ultimately there's opportunities in chaos. I think right now, and I'm like incredibly envious that you're at your point in your lives and in careers, we're at the beginnings of absolutely the next platform shift, and the next platform shift is to AI. And AI, by its nature, because it learns in real time, and the more there's interaction with it, the more learning that happens, ultimately, AI is going to be even faster of a platform shift and create more opportunities than mobile. So you might see investors start to invest more in AI as a result, because we need big markets. We need companies that have an opportunity to become billion or increasingly trillion-dollar companies. And absolutely, the next set of winners are going to come from AI. So you'll see there's already a rush to invest in companies that are either building for generative AI or building on top of it, or sort of like pivoting to that. You're going to see that more and more, absolutely. Other questions? Please. What do I plan to do next? I haven't thought about that. What was your name? Randy. Okay, Randy asked what I plan to do next. You get into venture and you make a commitment for 10 years for every fund, right? So, we've started a venture capital fund, or venture capital firm. We've already raised 2 funds. Our second fund is relatively early in its life. So right now, all I'm doing from a professional perspective is trying to find the best companies for that fund. And then we're going to be managing that fund for another 6 or so years. So professionally, like, I'm basically all in until 2031 if all we do is work on these next couple of funds. But what's interesting is I don't know what that means. Like, nobody saw ChatGPT coming. So has anybody used ChatGPT? Is everybody using it? Awesome, good. Are you using it for your schoolwork? Nobody answered. ChatGPT, it's been, and this is a good example of power laws and compounding. ChatGPT has been in the works for 7 years, but it became generally available only a few months ago. And as of a couple of months after being out, 100 million people have used it. So I think that I'm going to be focused on AI, and I wasn't necessarily focused on AI in this way for the next 5 or so years. And it's probably the beginning of the next wave. So I can imagine that I'm going to be doing more funds and focusing on these next great platforms like for the foreseeable future. So I think for me, venture is going to be a forever thing. And the question is, and oftentimes you see this, sometimes if you were a founder and you become a VC, you start to get the itch a little bit to like start things because you see all of these great companies, you see this like great technologies, you're like, wow, it would be super fun to start an AI company right now. I could imagine that could happen to me at some point in the future. But thankfully, we're building up a firm that I think we've got a team that can continue fund operations if I want to jump in and do AI. But my wife probably, she's sitting right there, she probably won't allow that. So for venture, it's a long-term game. It's the whole sort of like thesis behind this discussion. You need to find the best companies. You need to spend 10 years trying to help those companies and ultimately deliver a great outcome. Great question, though. Thank you. Yeah. Two-parter. Okay. What was your name? Vicky. Thank you, Vicky. So Vicky had an interesting two-parter question. And maybe it's like one question, right? Which is like for a scientist, maybe a data scientist, a climate scientist, even better. Do that. Forget about AI. Climate scientist, right? So for someone who's a specialized scientist, what is the path to ultimately becoming a VC? There's basically 2 paths to VC. It's a super weird industry. It's very hard to get into. You either need to be hired into a firm, right? So if there's a firm that is focused on climate, and thankfully there's a lot of firms focused on climate right now, oftentimes it's people like me who have a thesis around it, know how to sort of like raise and manage funds, but aren't necessarily in the middle of it and understanding the ins and outs of the space and being able to understand like what a good company looks like, where everything is going. So working at a firm that is focused on climate in this example, I think is the one path. And then the other path, which is the path that frankly I had to choose, is you need to have your own career. You need to do like well such that you can become an investor yourself. You need to build up a track record. And then ultimately, if you do that, you can, typically show some results and be able to raise some outside funding. The second path is a path again, that I had to choose because nobody was hiring me for a venture capital firm that was focused on the area that I thought there was real opportunity for. But the good thing is that path is increasingly available to everybody. And it's a path where if you're deep in a space such as climate, and you have unique knowledge, and you start to build up a network of other people that are building companies in climate, and you help them, and perhaps you get in a position to invest in them, you can do this thing yourself. And I think that's probably the way that if anybody asked me for advice, like I would recommend, because again, oftentimes the best investors, they started by being founders or employees, and they, bring a lot of knowledge that just like pure play professional investors don't bring into the space. So I think the path is there. The path is frankly the same one that I chose. It's just a matter of like timing and being able to build up the expertise, the resume, and the network to ultimately, get to the point where you can help startups, invest in startups, and then maybe build your own fund. Does that answer the question? Cool, awesome. Please. Yeah, no problem. Mm-hmm. Yeah, great question. What was your name? Brittany. Okay, thank you, Brittany. Brittany asked, amongst the sea of pitches that we might see every single day, week, month, what stands out? What do we use as the factors to make a decision? Okay. So even though we're like super specialized on one sector, like we'll see upwards of 25, 30, 50 investment opportunities per month, like new companies starting. So you break that down, like oftentimes days are just like pitch after pitch after pitch. We tend to be like really early stage focused because we think that that's where, at least in the sector that we know very well, a lot of the opportunity is. So we have like like 3 or 4 different factors that we'll use in making an investment decision. It's team, it's market, it's vision, and traction. The earlier stage that a company might be, right, if it's like you and your co-founder and it's an idea and a PowerPoint, we have to weight team more than anything else. So what is it about these founders? What is it about their vision, their background, that we think that they're going to be a team to bet on? As products are built, as the sort of like fit is identified, we can start to weight the other factors. And ultimately, if it's a later stage business, there's product market fit, there's revenue, so on and so forth. But for early stage investors, and frankly, where we see the most opportunity is in early stage investing, so much of it is about team. So much of it is about team, the market, right? Is the market something that we think is large enough that is going to be a billion-dollar market opportunity? What is this team's vision? Does she think differently about the world? Can she articulate a view of the world that we think is interesting, exciting? We can buy into it. We think we can help. And then if there's product and revenue, that's more evidence that we should say yes to this entrepreneur's pitch. But again, sometimes we throw the whole thing out and we're like, well, we think this idea isn't that good, but she's amazing. And frankly, some of our best investments to date have been just like high conviction bet on a given founder and team. It's sort of like at once difficult, right? Because you don't really know if your background matches the thesis of an investor, but at the same time, it's actually sort of like flattening in terms of if this is all about team, if it's all about vision and being able to paint a compelling vision, like you probably have a shot. Make sense? Cool. Other questions? Yeah.
So there is that category of startups that pretty much can only exist when they're that. They require massive amounts of capital to
Yeah.
get the first product out the door. So then there's the other category that kind of sit in a space option where they could raise capital or they could take the long haul and bootstrap it all the way. Have you seen, or how often do you see some companies raise capital who didn't necessarily need to raise capital, and then it ended up being a bad thing for them in the long run?
Yeah, you see it all the time. Unfortunately, I'm sorry, what was your name? Nathan. Okay, Nathan's question was, so there's 2 routes, right? There's the VC route where it's like, hey, this is a massive opportunity. This opportunity needs capital and rocket fuel and go, go, go. Or there's the, hey, let's just build a business, sell it to some customers, and be able to grow sort of like incrementally from there, right? If you think those are the 2 paths. Nathan's question was, what happens if a company raises money on thesis A, that this is a venture scale opportunity, but it actually turns out to not be, and it might be like a good biz own and run and be employed at. Unfortunately, when that happens, it ends up being really bad for the founders. Because let's go back to the power law. Venture capitalists invest in companies because they think this is going to be a billion-dollar outcome. Our model is not this, but oftentimes the venture capitalists, they end up owning a lot of the company. They end up being on the board and having decision-making capabilities, and the alignment between the founders and the VCs can differ. And the founder might not have an opportunity to just detach, regain ownership of the company and move it in a different direction. It could end up being a forced sale or a forced liquidation. And I think, unfortunately, more of a comment on the past few years, you know, we're just coming off of a time of like insanity in venture capital. And if you come to the discussion later on, where it's Matt, Jason, and myself, I think we're going to talk about this stuff a little bit more at 4:15, where every company was getting funded, it felt like. It was just like massive FOMO, especially for somebody like me that tries to like be disciplined and invest in good companies and like invest in companies where they're going to be profitable. You were seeing companies getting investment at ridiculous valuations all the time. And a lot of those companies, they're kind of DOA because they raised a ton of money at a ridiculous valuation. They're not going anywhere. And unfortunately, it's not going to be a good outcome for them. So my advice to anybody that's an entrepreneur and wants to avoid that type of situation, it's pretty simple. Like, go in eyes wide open, knowing this idea, right, that, you know, a venture scale business is a very specific type of business. Uber, Airbnb, like Apple, Microsoft, those are venture scale businesses. Most businesses are not, but frankly, like, that's okay. That's awesome. You can bootstrap that type of business, control your destiny, make your own decisions, and not need to worry about all this stuff. And most businesses, I think, are better off just going that route. Weird coming from a VC, but it's true, you know? Any other questions? Please. Gotcha. Name? Promise? Promise. So the question was, how do we interact with data science as venture capitalists, and what's the path for data scientists in venture? So data scientists are, it's in the sectors that I focus on, right? Like marketing and advertising, data scientists are gold. They're so important, and every company that we end up funding, either they are data scientists or they hire data scientists. Because so much of, you know, again, I sort of like, it's marketing technology, right? So much of why you see a different ad than she does and that Promise does, it's via data, it's via algorithms, right? So much of the business of marketing runs on data. So data scientists are in high demand. And it's not unlike the answer I gave for the idea around sort of like scientists that are focused on climate. It's like, my advice, like, build a career, build up great experience, build up a network, and you're going to have your choices on if you want to start a company, join a company, or ultimately take a lot of those skills and use them as a professional investor, whether it's joining a firm or doing your own thing. Other questions? Yeah.
My name's Josh.
Yachts.
Jumping off of what Thomas said, you were talking mainly about how the companies that you fund utilize data science.
Mm-hmm.
But I guess my question is, how do you utilize data science in looking at companies or looking at what ventures fund?
Mm-hmm.
Does that play a role?
We don't, so, and maybe I didn't answer this correctly from Promise. I'm sorry. So the question was, do we use data science in our day-to-day operations? We're not at the scale where we're using sophisticated data science. Again, we're very focused on the early stage of you know, a given market and you know, companies. So oftentimes there's not a lot of data to go on past like what we understand about the market and how we feel about a team, right? If it's like founders, a PowerPoint, an idea, an interesting market opportunity, we love that stuff, but oftentimes there's not a lot of data, you know, it's not a data-driven decision. The later stage a company gets, and we'll invest in some later stage companies, we'll then have certain metrics we'll look at, but we're not employing data science to sift through all of those things. I think there are, and again, if you come back later on, it's a good question for Jason. Jason Warner is a VC at Redpoint, one of the largest venture capital funds in the world. And I think they employ that because they operate at a way different scale. Other questions? Yeah, go ahead. Hey.
So, how can you describe and differentiate to us venture capital versus angel investing, and why would a startup go forward?
Okay, good question. So what's the difference between angel investing and venture capital, and why would a startup choose one or the other? The answer is most startups end up doing both, right? So typically, not always, but typically the first capital that a startup raises is not from venture capitalists. It's from, oftentimes it's known as like friends and family, i.e. angel investors. That's how I got my start. I had worked in a space for a really long time, was able to do okay from a career perspective, started to see people that I knew that had worked at companies once or twice now start their own companies, and I had the opportunity to invest as an individual, as an angel investor. Angel investing is for individuals. You need to be an accredited investor, right? So typically it takes a little while to get to that point from a career perspective. But the first capital that a company will typically raise are from angels. That's to just like get this thing out the door, get it up and running, get us to the point we can go pitch a venture capitalist. If this is a venture scale business, goes from angel to venture, and then it raises a few rounds of venture funding from typically like different firms that operate at different stages. Most companies do both. Some companies have been extreme outliers where they raised some angel money, never raised any money again, and then became billion-dollar companies. They are so few and far between. If this ends up going the traditional route, it's both, it's not either or. And the good thing about that is like there's a lot more angel investors these days, partly due to the innovation with platforms like AngelList and so on and so forth, that sort of have democratized angel investing and give the opportunity to reach, give the opportunity for founders to reach out to angels that they wouldn't typically know. Yeah. What does a typical day of a VC look like? I take this thing, I stand at it, and I'm like going for like 10 hours. Typical day is a lot of startup pitches. It used to be I would like travel. I would take meetings at our office in New York City. But over the course of the past few years, lots have changed with the advent of remote work and the shutdown due to the pandemic and everything like that. One thing that hasn't changed is my industry went to Zoom and like never left. And it's been I think it's incredibly fortunate for startups because I'm now used to doing Zoom pitches all the time, all day long. So a typical day is taking a lot of pitches, taking a break, trying to think through everything that I've just seen, make some notes, and then continue on to the pitches, right? Because if we're looking at 25 opportunities a month, that's a lot of Zooms. And then I'm either doing first pitch meetings or second or third meetings with companies that I think are interesting, that I think we want to go a level deeper, and I want to bring in either more members of my team or subject matter experts to really go down the path of understanding this business better, understanding this team better. And then once a week, we meet as a firm to talk about everything that we're doing, to talk about the portfolio, to talk about investments that we're sort of like voting that the firm needs to make. Venture capital is a little bit like real estate. So like a real estate brokerage is a collection of individuals that sort of like operate under the same brand, operate under the same roof, but then go and do all of their own thing and then come and make collective decisions together. It's a little bit like that. So I don't interact with my partners. I have 4 partners in the firm all that much until we're looking at something together, or we're doing something sort of like for an existing portfolio company. We're just like off meeting founders, having conversations, trying to understand our view of the world as it relates to a specific investment. And then we come together as a team and discuss, debate, do so live. And that's typically on Mondays. So a VC is like a lone wolf. They're just like either doing Zoom calls or like having meetings, doing a lot of coffees if they're sick of being in front of their laptop, and just going. Yeah. Need to be ready for that from a career perspective, because what I just described, I mean, it's not work, right? Like I'm just like sitting there doing Zoom calls, like trying to, understand investment opportunities, help teams. I'm not there necessarily producing anything, which I think is an important thing. Like you need to be at a point where you've done the work to be able to, step and start to have the leverage of being able to just apply ideas and judgment than, just sheer work and manpower. Any other questions? Yeah. Yeah.
Do you think a pitch in person or a pitch online, does having a pitch in person have a better impact or be more effective in getting your message across?
Yeah. No, it's a great question. So the question was, if you spend all your time on Zoom, is it better or worse than doing it in person? The best interactions are always in person. If I have the opportunity to sit with a team, just pick up on nonverbal signals, just like have a little bit of that like pre-meeting small talk that you don't get when you just like light up a Zoom. It's like, okay, go, like all that stuff. That's like, those are important signals that you don't get through Zoom. So my preference is to do as much as possible in person. In reality, Zoom ends up being number one, a good filter, right? Maybe I'll take a first meeting over a Zoom, just to see, just like get an idea for the team and the product. It allows me to pack a lot more into the day, right? Because like if I'm just like in New York, like running around to offices and having people visit me, there's only a certain amount of meetings I could pack into a day. I mean, I can go on Zoom. Anybody can go on Zoom for a long time if you're like being disciplined and blocking off half-hour or hour segments. But before 2020, if you would have told me, Eric, you would invest in teams that you never met in person, you would be wiring LP's capital, people's capital you're responsible for, to people that you have never met and you might not meet for 2 years, I would have said, dude, you are crazy. But you know what? That's like how everything moved. And thankfully, nothing, at least for us, blew up in the process. But ultimately, we love to spend time with our teams, and we try to foster that. But there's still companies that we invested in a few years ago that are doing fantastic, and they're located in the UK. And number one, I never would have invested in them, had I not sort of like gone to Zoom only. And then number two, like we haven't had the need or opportunity to meet. So it's weird. It's been a learning curve and adaptation for me, but for some founders in parts of the world that aren't necessarily like as developed as in the US, or like, half a world away from the US, they've been able to do things that they never would have been able to do if this thing hadn't been sort of forced on all of us. So it's a double-edged sword, but it was weird. The first like investment that I pitched to my firm, like, hey, let's like invest in this company. I've never met them. I think they're real. And they're located like in the middle of nowhere. It was a weird thing, but thankfully, nothing blew up in the process. Yeah. The power law. Mm-hmm. That's how the profits are shared. So the power law is this idea that the best companies end up driving all of the profits. Those profits are then shared between LPs and GPs. So go on. Yeah, great question. So the question was, What do you do to put yourself as a firm and the companies in a position to have a chance of being one of those like massive outliers? Summary? Good summary? Okay, good. I can only speak to us because this is how we think we're best suited to help. So it's number one, we only invest in what we know. So if my friend here starts a climate tech company and I think he's great, I think the idea is great, it's just like, where do I start? I don't understand this space. So number one, we only invest in what we know. Number two, we've actually built an investor base that is not just institutions and foundations and endowments, but it's companies within the marketing and media ecosystem, and it's execs and founders within the ecosystem. So for a given company that's trying to get to, insert like big brand or media company, sometimes they're investors in our fund and the incentives are aligned, or sometimes they're a hop away in terms of us having a relationship with them. So we invest in what we know. We try to keep the potential customers and partners sort of close to our ecosystem to get to know our companies and be in a position to understand and work with our companies. And we'll just work with them for a really long time. So everybody needs to have a bit of an edge, a bit of a defensible edge, and that's how we do it. Other questions? Yeah, go ahead.
So once you decide to invest in a company and they become a part of your portfolio,
Mm-hmm.
you say that you work with them, but what does that look like? How often do you hold,
Are you accusing me of not doing any work again?
how often do you hold meetings with companies you're invested in?
Yeah.
They report back to you the progress. What does that look like day to day, week to week, month to month?
That is an awesome question. So the question was, how do we interact with portfolio companies? We invest in a lot of companies. So our pace for our investments is like one investment per month. So we have right now like 57, 58 active investments in our portfolio. So, and we're investing in a new deal per month, right? So the majority of the time, we're not like doing structured, long meetings with our teams, with our portfolio. How we work is really two things. Number one, when we invest, we want to like get this thing going out of the gate. So we will do a session post-investment where we've already done a lot of the work with the team and we understand how we can help them like right out of the gate, where we'll do a session. It's like, okay, here's the 3 things that we can do that could be maximally impactful for you right now, right? So we're sort of like paying off on the promise of working with a specialized fund. Let's get you in front of this company. Let's do this for you. That's number one. Number two, most good companies do a monthly investor update. So it's coming to us, and most good companies have a specific ask of that investor or their investors, like, hey, here's a company we're trying to get to, here's a thing we're trying to do. Like most of the companies are really good about putting their investors to work. And then number 3, again, this is a little bit of the advent of technology. We're on Slack all day long. Do you guys use Slack? Yep, so we're on Slack all day long. All of our companies are on Slack. We're on Slack, ourselves. So for those day-to-day, like, hey, got a question, need a thing, they can reach me like 24 hours a day. And again, it's been one of the benefits of, just technology sort of starting to permeate in the way that we've seen it over the course of the past few years. And then, quarterly or so, when there's something bigger going on, or if it's like, hey, need the bat phone, there's a M&A interest, then we'll start to get really, really involved. So it's like out of the gate, look to add a lot of value, here for us at that monthly cadence, here for you at that monthly cadence, when you need something, and then just sort of like all day long and real time. That's our model. It seems to work. I think we're at time, right? 1 minute. Do we have any questions from the internet? No questions from the internet? Okay. Anybody got another question? Okay, great. We'll stop it there. Thank you, everybody. This was fun. Appreciate it.